Hello, and welcome back to Explain the Charts, your go-to channel for no-nonsense technical analysis. Today is November 26, 2025, and we are taking a close look at the QQQ, the Invesco ETF that tracks the Nasdaq 100. First, let's cover the news and the overall market sentiment, as it's been a very active few days. Headlines are overwhelmingly positive, with major outlets reporting that Wall Street has rallied for 3 consecutive days. This optimism is largely fueled by growing expectations that the U.S. Federal Reserve might implement its final rate cut of the year in December. Economic data seems to be supporting this narrative, as reports mention cooling retail sales, which could give the Fed more reason to ease its policy. However, it's not all one-sided. The Producer Price Index, or PPI, showed a rise in inflation, and one Reuters report noted some softness in the tech sector, which limited Nasdaq's gains slightly. There is also a lot of chatter around AI stocks, with investor appetite for the sector remaining strong and potentially driving a large part of the market's performance. So the macro environment is bullish due to rate cut hopes, but with some conflicting economic data points that we need to keep in mind as we look at the charts. Now, let's switch over to the daily chart for QQQ to see how this news is reflected in the price action. Looking at the bigger picture, QQQ has been in a powerful and sustained uptrend for most of 2025. After a volatile period in early April that saw a massive V-shaped recovery from a low near 402, the price has been making a series of higher highs and higher lows. This uptrend culminated in an all-time high of $637, which was hit in late October. That $637 level is now our most significant long-term resistance. Following that peak, we saw a healthy pullback and consolidation period throughout early November. The price found a strong support base around the $585 to $590 area during a sharp drop on November 20th. This level has proven to be a critical short-term floor for the market. Now let's zoom in on the more recent price action from September onwards. You can clearly see the final push-up to the 637 high, followed by the corrective phase. Notice the high volume on the down days, like the big red candle on November 20th, which indicates significant selling pressure or profit-taking near the highs. However, the last 2 trading days, November 24th and 25th, have been strong green candles, corresponding directly with the news of a market rally. We have now reclaimed the 600 psychological level and closed yesterday at 608.89. This recent strength suggests buyers are stepping back in, fueled by the optimism around the potential Fed rate cut. To get an even clearer picture of this recent rally, let's drill down to the 15-minute chart. Here we can see the price action from yesterday, November 25th. The day started with a drop in the pre-market, finding a bottom around 597. However, buyers stepped in aggressively right after the market opened, pushing the price steadily higher throughout the day. The momentum carried QQQ through multiple resistance levels, closing very strong near the day's high around 609. This intraday trend is decisively bullish and shows a clear rejection of lower prices. The price action is currently consolidating just below the 610 level in the pre-market session for today, November 26th. Now, if we look at the hourly chart, we can analyze the market structure on a slightly larger time frame. While this hourly data is from earlier in the month, it shows a period of choppy consolidation between roughly 610 and 626. This kind of sideways price action is typical after a strong move, as the market digests gains and decides on its next direction. It's a good example of how ranges can form, with clear support and resistance. The key takeaway here is that breaking out of such a range, as we are attempting to do now, can lead to a significant expansion in price. A sustained move above the 610 level on the hourly chart would be a very bullish short-term signal. So, let's put it all together and consider the bullish and bearish cases. For the bulls, the argument is strong. We are in a long-term uptrend, and the short-term momentum has shifted back to the upside. The market is clearly reacting positively to the prospect of a Fed rate cut, which acts as a major tailwind for growth-oriented tech stocks in the Nasdaq. A clean break and hold above the immediate resistance at $610 would open the door for a move towards 620 and eventually a retest of the all-time high at 637. On the other hand, the bearish case relies on the recent high at 637 holding as firm resistance. Bears would argue this is a relief rally in a new downtrend or a larger consolidation phase. If the price fails to break above 610 and instead falls back below the psychological 600 level, it could signal that sellers are regaining control. A break below the recent support at 585 would be a significant bearish confirmation, potentially leading to a deeper correction. To summarize, here are the key levels and scenarios to watch. Immediate resistance is at $610. Above that, the next major target is the all-time high around 637. Immediate support is at the psychological $600 level, followed by the more critical support zone around 585. My primary prediction is a continued push higher to test resistance. I'd place a 65% probability on an attempt to break 610 and move towards 620 in the short term. This scenario is reinforced by the current positive news flow and bullish market sentiment. Conversely, there's a 35% probability of a rejection at 610, leading to a retest of support at 600 or 585. This would become more likely if we get unexpected hawkish commentary from the Fed or negative inflation news. Moving forward, keep a close eye on upcoming inflation reports and any statements from Federal Reserve officials, as these will be the primary catalysts. Thank you for watching Explain the Charts. If you found this analysis helpful, please hit the like button and subscribe for more content. Remember, this video is for informational purposes only and is not financial advice. Always conduct your own research and make investment decisions based on your own due diligence.